what is the value menu, right? What is it? What does it do? Why should I be remotely interested in it? And as Jim said, a lot of discussion. I think a lot of times people will maybe add their own secret sauce in, and that's fine as long as you know what you're doing, right? There's 100 ways to skin this cat. Problem is 90 of them are wrong. That leaves 10 that are right. IBM might be a good value menu setup as well. Yeah, there's your pullback on IBM. So if we can bounce here and start to continue to go higher, great. If not, ideally, here's what would get me excited. If we closed where we are right now this evening, why would that get me excited if IBM's candlestick looked like this evening? What would get me excited about that? Yeah, it's a small-bodied candlestick or a doji at a moving average in a bullish trending stock that has recently traded to new higher highs and new higher lows. The trend is intact. Buyers are still present. And so, until and unless we trade to a lower high, I'm willing to take a shot on these. And it's a fairly low-risk trade because of where our stop is. One of the ways to manage that is with the value menu trade. So let me just put the criteria up here first for value menu type trades. We'll have the stock criteria and the option criteria up here. So let's put the option criteria over here. And then we will have our risk management or position management plan out here. And it's going to be important that you keep in mind that I put that as risk and position management, right? So let's talk about our stock criteria. Our stock criteria is that I want volatile stocks. And guys, understand, I want volatile stocks that trade with heavy volume, right? I want stocks that have good volume, because if I don't have stocks with good volume, what tends to happen is you get crappy patterns and you get really bad option pricing, okay? Now, I actually used to put a number to the stock criteria with regards to average daily range or average true range. I've gotten away from that. I don't do that a lot. You know what we're looking for, right? We have an entire list of stocks that we trade value menu strategies on in the morning lab. If you're interested in that, obviously we go over that frequently here in class, and we talk about what those stocks are, and we trade those stocks. You guys have seen us do a couple of them here this morning with Facebook, Baidu, IBM had a nice setup for it. So those would be the kinds of things that we do our value menu setups on. We want heavy volume on those. Our option criteria are that we are looking for an option that is as close to, but not over, $2. Okay, so we want an option that is as close to $2 as possible without going over $2, and at the same time is not more than $5 out of the money. Okay, so I can find a $2 option on just about anybody, right? Problem is going to be that it's going to be, $50 out of the money on Priceline. Well, that isn't going to help me out. It's not going to get there, right? And so what this part is we're basically looking for a flawed pricing model that the market makers have not basically put in enough time value to offset their risk of having to pay us a bunch of money. All right, so that's, I don't know about you guys, but I like it when the market maker has to pay me money, not the other way around. Okay, so that's our option criteria. Let me add one more in there to both sides here. It needs to be a weekly option, right? And it was kind of funny. I just finished teaching, where was I? San Francisco. And there were some folks out there who were shocked and amazed that we would dare to trade the weekly option, right? Stunned. Couldn't believe it. Why are you trading those? Because we make a crap ton of money on them when you do them right, right? So we want, and I say I'm going to add this to both sides, both the stock criteria and the option criteria, right? So I'm going to need a weekly option that costs around $2 but never more than $5 out of the money. That means I'm going to need it to be a stock that has weekly options. There's no point looking at the ones that don't, and then you're only trading it once a month. There's your entry on IBM. So again, going through, I'll do the examples and then we'll speak about them. There's your Facebook, another entry, a later entry there on Facebook, getting a rising 3-method candlestick pattern on a retracement here on IBM. So we'll go in here and we'll follow those criteria. IBM, fairly volatile, yep. Option that is $2 or less, not more than, as close to $2 as we can, $1.87, right? Next one up is $2.57, so $1.87 is as close as I'm going to get, and it is a weekly option. So the 149 call option is what I'm going to buy, and I'm going to buy the other 10 contracts now. So I bought 10 contracts earlier on the original run. Now I'm going to go in and add to that position. Now I've got a full 20 contract position on IBM. So there's how we're going to do that. Let's go back over and take a look at our, there we go, there it is, our chalkboard. Weekly option, as close to but not over $2, not more than $5 out of the money. Okay, so that's what we're looking for. One more thing that we want to do here, and I'm not going to quantify it, but I like to have a tight bid by ask spread. Okay, so I want that to be a small amount. Generally speaking, we're able to overcome maybe a 60-cent spread if we really work at it, but I want a small bid by ask on this. You know, what's that going to be? I would say definitely less than 60 cents. Sometimes we've done a little bit more than that, and that's okay. But we want a tight, small bid by ask spread. Okay, now our risk management, position management for the value menu, it goes like this. We always trade with a stop. Typically, it's a 30-cent stop on the entire position. Okay, so we start out with a 30-cent stop on the entire position. Then we move into, we will take 1/2 of the position off at, let's just say $4, right? It's at 100% rate of return. That's important. But here's the deal. If you take half the position off at $4 and you bought it at $1.79, you're making more than 100% rate of return. So that's not going to hurt you any. Okay. We take that off. We take that off and we put it in the bank. What can you do with money that's in the bank? Is this thing working? Can you hear me? You know, trading. Hey, you can buy stuff. Thank you, Beth. Good to see you, Beth. Bruce says you can do whatever you want with it, and that is correct. Jose says you could use it in another trade if you wanted to. It's profit. It's now realized profit. And there you go, Brian. Buy some new shoes with it. Guys, on 20 contracts, if we take half the position off at $4, that's about $2,000 profit that's now gone in the bank. And the thing about the money in the bank is the one thing that you can't do with it is lose it in a trade unless you put it in another trade. All right, so you have now taken that profit, you've put it aside, and let's just go there for just 1 second, because sometimes I wonder if people really understand the power and magic and genius of what I teach here. Let's say you go in, you buy 20 contracts, right? You buy to open 20 contracts at $2, right? And the option price goes up to $4. So you sell to close 10 contracts at $4. All right. In this trade right now, I have sold half of my position. How much risk do I have in this trade? Good answer there, DC Jim. I love that. Jim says, well, with that $2,000, you can buy a new scope for one of your rifles. Exactly. How much risk do I have in this trade right now, guys? What is my risk to my total account value in the remaining 10 contracts? At this point in the trade, ladies and gentlemen, I have 0 risk in the trade. Everybody with me? Trade goes against me, I'll be zeroed out. I'll be at break even. If this goes all the way back down, I'll be at break even. Okay, I just want to make sure that everybody understands how important that is and why we're doing it. I think a lot of times people are like, you know, it cracks me up when people try to use my own words against me. Well, unless they're right, then it doesn't crack me up, but most of the time they're wrong. So they'll say, well, Bill, you're just taking that position off because there's a profit, and profit's not a technical indicator. And I'm like, that's very good. I'm glad to see you took notes. Profit is not a technical indicator. Profit is not a technical indicator. As traders, we are gamblers. We are speculators. Embrace it. Become good at it. A good gambler, a good speculator focuses on risk, and amateur chases profit. Write that down. A professional focuses on risk, and amateur chases profit. What I am doing here by taking half the position off is a risk management technique. Once we get to that point, I am going to move my stop from 30 cents to my cost. In other words, I will move my stop from where I got in, $2. When I first got in, I placed a stop where? We said 30 cents away, correct? So I have a sell at $1.70 stop in this trade, right? When I first bought this position, when I first got into this trade, before I sold those 10 contracts, this is what it looked like. Yes? Everybody with me? All right. Then we ended up selling half of our position because the option got to $4. So at this point in the trade, we are now going to move our stop from $1.70 to $2, and you can do it for a nickel or a dime, but that's as high as you're going to be allowed to go there if you're following the rules, right? So I'm just trying to make up a little bit of the bid-ask spread there. So I'm moving my stop. I'm like a master with Microsoft Paint, aren't I? I'm now moving my stop to my cost basis on the trade. So now if the trade goes against me, now if the trade goes completely against me, I have 10 contracts left. What would my risk be in this trade at this point? If this trade goes against me now, how much will I lose in this trade? Okay. Not only do I have no risk, there you go, Bill, thank you. Bill says, remember, you took a profit, right? You sold half of your position and you took a profit of $2,000. So at this point, if this option goes from $4 all the way back to $2.10, I'll be taken out of this half of the trade. I won't make anything, but I won't lose anything on that half of the trade. But I put $2,000 in the bank. This is risk management. This is the risk management side of this trade. So we move our stop from 30 cents to our cost basis, and then one of the most important parts, leave it alone. Leave it alone. Don't freaking mess with it. Stop it. You'll leave it alone. And then close it near. How about we do that? That means on Friday. And this is the part where you're going to mess it up. Right? I mean, some of you in Baltimore may be a little bit shocked that I'm willing to give you the entire recipe for the value menu setup. right? Why wouldn't I just give you a little bit of it, tease you with it, and then encourage you to come in the lab? Well, obviously, I'm going to encourage you to come in the lab. We'd love to have you here, but we got a ton of people in here, right? We don't need you in here. We would just love to have you in here if it's something you're interested in. We already got our own thing going on here. So why in the world would I give you the recipe? Here's why. I believe in you. I am fully confident in your ability to screw this trade up. And then you'll be coming back to me and saying, how'd that thing work again? Because I can't seem to get that trade to work. You will. You'll say it to me. I've heard it before. The two places that you are going to mess this up is here and not waiting for this. Wow. Brian shares with you guys an experience. Says, I once closed an option on this trade when it was at $7.50, and on Friday it ended the week at $22.30. Chasing profit instead of focusing on risk cost me $15,000 in missed opportunity. Y'all don't have to believe me. You can believe him. Any questions from the Baltimore crowd on value menu? Leave it alone. Dean says, I've seen that movie as well and didn't like it. In fact, some of you have heard me tell the story about Dean closing this trade too early.